home equity line of credit versus cash out refinance. Super common question. Home equity lines of credit by common practice are typically variable rates. So you're talking about they're variable based on the prime rent lending rate plus or minus some percentage. So when prime is low, and it might be plus or minus a small percentage, that rate may be lower or higher. Like that starting rate may be lower or higher than the then current 30-year fixed rates for a cash out refinance, where the client could take the same amount of money, put in a cash out refinance at a fixed rate, and that's the other alternative. So home equity line, variable rate, line of credit, use the money, pay it back. It comes off the line, and you pay interest only at a variable rate on the money while it's outstanding, versus cash out. Further, defining the two, and then we're going to talk about the pros and cons of each. Cash out refinance is, example, you have a home that's worth $400,000, you owe $200,000, you want $50,000. And so you refinance your mortgage, make the mortgage in the $250,000 range, in which case you net $50,000 at the closing of the refinance, and you have a fixed 30-year, 15-year, 25-year, whatever number of years you want on that term at that fixed rate. Most of the rule of thumb here is going to be, if you have a specific use for the money, and you do not intend to pay all of that money back within the coming 2-ish years, then you really want to look at the cash out refinance. Now, assuming cash out refinancing rates are good, which in the last handful of years, they've been terrific, and most of the time favors the cash out refinance. The reason that you don't want money to live on a home equity line for a long time is the variability in nature. And so as prime rises, that rises, which, makes the cost go up. So a home equity line is going to be terrific for a rainy day. Like you want to have a line of credit to tap into if your furnace breaks, your hot water heater goes, or you have a sudden expense. A home equity line after you've closed, whether it be your purchase, your rate term refinance where you've just moved to a lower rate, or your cash out refinance, it is valuable to have a home equity line behind that for a rainy day. But if you have a use for the money and you don't intend to pay it back within a year to 2 years, you're most likely going to be better off with the safety of a cash out refinance at a fixed rate.
Raj, real quick, why wouldn't you want the HELOC if you were going to have it for more than a couple of years? What would be the concern?
Yeah, the concern there is going to be prime going up. And so if it's tied to prime might start at 3.25, but over the next couple of years, we've seen prime can get pretty high. So if someone wants to look at a chart, they can just Google search a prime lending rate chart, and you can see over the past 20 years, prime has gotten pretty high. So if you take a look at that versus the current rates on cash out refinancing, and knowing that you can fix that rate in, there's very few people that would choose the home equity line for money that they knew was going to be out there.
Avoid that much higher rate down the line, or the potential for it to increase and have a difficult time with the payment then.